Welcome to Bloomberg Markets. I'm Katie Greifeld. Investors still left in the wake of that surprisingly strong U.S. jobs report as markets adjust to a likely more hawkish Federal Reserve. Let's get a quick check on these markets. Of course, you can see the question being asked. Is this Fed going to be as aggressive with rate cuts as maybe the market thought? Right now, seems like the answer is no, because you have the U.S. equity market, the S&P 500, down about 0.4%. Same thing if you take a look at big tech, of course, being weighed down here. That's because the bond market really acting up. Of course, the 10-year Treasury yield higher by about 6 basis points. We are above 4% as investors rethink their bets there. And of course, we had to put Brent crude up there as well. A lot of action in the oil markets as we continue to keep an eye on the Middle East. Currently, Brent crude above 80 for the first time this summer. That translates to a 3.3% rise. Meanwhile, let's get some midday movers on the equity side. We'll do that with Abigail Doolittle.
Well, having nothing to do with the Federal Reserve or the jobs report, Katie, let's take a look at some stocks that are down amid a slew of downgrades. We have Humana cut by 2 different firms, including TD Cowen, concerns around margins weighing, down 2.1%. Amazon cut ahead of its all-important Prime Day, with one analyst saying that the AWS business, it's not enough. Shares responding down 2.9%. And then Netflix receiving both a downgrade and an upgrade ahead of this earnings season. Right now, the bears holding it down 1.7%. Some analysts there really think that valuation is a concern. Turning to the shares of Pfizer, the last time I looked, at least they were higher, and they still are up 2.9%. This is value investor Starboard has taken a $1 billion stake, wanting to do an overall turnaround for a company that has really flailed since the pandemic and the vaccine revenue. Again, shares responding well, up 2.9%. And then finally, we have the shares of Tesla trading lower right now, down 2.2%. This could be ahead of the important robotaxi event on Thursday, Katie. And of course, we also have Elon Musk, CEO, giving a lot of support and time to Republican presidential candidate Donald Trump. Some investors may be worried that his attention is off the company and on politics, and that could also be another reason that we have this stock down for a 3rd day in a row.
All right, Abigail Doolittle, thank you so much. An update there on the public markets. Let's turn to the private markets, though, because as appetite for private assets grows, today we learned that iCaptial has surpassed $200 billion in global platform assets. And for more on this exclusive news, I'm pleased to say we're joined now by Chairman and CEO Lawrence Calcano, along with our own Shonali Basak. And we should also note, of course, that Lawrence will be speaking tomorrow at the Greenwich Economic Forum. Lawrence, it's great to have you with us. So $200 billion in AUM. You think about private markets, that's a pretty broad church. Where are you seeing the most flows right now when you dial down into the private markets?
Sure. So thank you, Katie. It's great to be here. I really appreciate it. So I think you look at the flow question from 2 different perspectives. The first is, what are the strategies that people are using? And then second, what are the structures they're using to get into the asset class? So on the strategies, we're really seeing a shift more to private credit. If you go back 2 years, back to 22, and you remember the economic environment was uncertain, we were about to start a Fed rate hike trend, and there was really a risk-off mode in the market. So in that context, private credit, which is shorter duration than private equity, people started to shift there. Most of the private credit products are floating rate. And so people had a natural hedge, in their investment. And as time went on and interest rates went to, 5 to 6%, people were earning almost 10% or a little bit more on their private credit portfolio, which was very, very exciting. We've seen flows into private credit year to date of about 41% as compared to private equity of 34%, which is a flip from last year. And then the other quick point I'd make on the structures, we're seeing a big shift to evergreen investment structures as opposed to the traditional private placements, which people had historically always used. And that's really a function of more accredited investors coming into the asset class. And those products we've seen to the tune of about 60% of the flows year to date versus 40% for the private assets.
Lawrence, Katie and I have both been covering the advent of a private credit ETF, Apollo and State Street, really breaking the gate wide open in terms of seeking approval for one, still needs regulatory approval. But let's look around the corner for a minute here. And should they get this done, how fast do you see more of these entering the market, and how will that change the way that retail investors access these funds that have been typically hard to access?
So I would say that, you're going to see more of that. And you've seen it on the M&A side with a lot of traditional asset managers acquiring alternative asset managers. You're going to see more and more partnerships come to the fore, as you're suggesting, as people think more holistically about these portfolios. We always think that, though we are obviously driving the volume in a lot of alternative assets, they live somewhere. They live in a portfolio, and they have to make sense in the context of the portfolio and what the underlying investor is trying to accomplish in that portfolio. So I think you're going to see more of these types of arrangements, and I think ultimately they will really help the investor, because right now one of the challenges that advisors have is making sense of how do you allocate, how do you bring these alternative assets into a portfolio.
Well, one major issue, too, is the liquidity profile. When people look at the ETFs, they say, well, wait a minute, you're taking an illiquid asset, putting it into a very liquid structure. But you've seen these interval funds throughout the last year, some very successful, but some, of course, getting into some issues when it comes to redemption requests. How are investors thinking about that structure? Whether it'll be semi-liquid, do they want daily liquidity, or do they not want liquidity for these structures at all?
So, look, I think it's really early days right now for all of this. And so a lot of people are experimenting on how to make this all work. I think the one thing you have to keep in mind, and that is an alternative asset, generally speaking, is an illiquid investment. So when you think about some of the funds that might have had gates put up, which is, by the way, a feature, not a bug, of how those products are designed, they are ultimately investing in long-lived, illiquid assets. And what people are trying to do is figure out how to put hospitable wrappers for this market around those products so that people can have that access. But you can't get away from the fact that these are still, the underlying investments are very illiquid. And so people have to understand that. I will tell you, one of the things I find quite frustrating is the description of these assets as semi-liquid, because I think human nature being what it is, when people hear semi-liquid, they hear what they want to hear, and they hear liquid. The reality is that these products are, generally speaking, illiquid with some liquidity features. And I think that's a really important component of the education that has to go on in this space. We certainly spend a lot of time on it, as do many of the leading asset managers, in really helping people understand the underlying character of these products and how they work and how they're supposed to work for investors.
Lawrence, it's a great point, and of course, making sure that's communicated to prospective retail investors in particular. I know a lot of ETF issuers who are thinking carefully about that topic. But I am curious, when it comes to retail investors moving into private assets, I have to ask, why bother when you have public markets that are up 21% year to date on the S&P 500, for example? What role do you see private assets playing in the typical portfolio of just the average investor?
Sure. If you look at the sort of large families, family offices, you look at institutions, many of those are allocated well in excess of 50%. If you look at the suggested allocations at most of the large private banks, they're suggesting allocations of 15 to 25% into alternative investments for their underlying wealth clients. And so the view is clearly that there's an opportunity for incremental return. People buy these things for the same reasons that large families and institutions do. They want, and they're seeking incremental return opportunities. They're seeking diversification of the portfolio. If you think about the private markets today, there are hundreds of thousands of private companies, and there are 4,000 or 5,000 public companies. So if you think about the market, not investing in privates is shutting down a very significant part of the marketplace to the underlying investors. So I think privates play a really important role in a complete portfolio. Most certainly, they will not be for everybody because of the liquidity conversations that we had a few seconds ago, as well as some other reasons. But I think for the right investor base, they can be very additive to the portfolio.
Yeah, it's an interesting point, especially when you think about the fact that we aren't seeing a lot of IPOs lately. We have seen some delistings, so it feels just like the public markets are shrinking, going into privates. And speaking of privates, you make the points in your notes that private credit has had a good run. It's had a lot of the mind share as well, but you see private equity growing in the months ahead. Walk us through that call.
Sure. So it's sort of the inverse of what I talked about earlier, where, you have, as interest rates were coming down, private credit became very, very attractive. Sorry, as interest rates were going up, private credit became very, very attractive given the hedge and frankly, the spread between the expected total return on credit that was then yielding 10% and equity was narrowing. As we now perhaps start a reduction cycle in interest rates, you're going to see the spreads in private credit and private equity start to widen again. And I also think as we get into sort of that climate, equities tend to perform quite well. So we would expect more allocation into private equity in the months ahead. But I would say very much that the private credit strategies are going to be a core part of alternative holdings. And I think as you look forward, when you think about how people will allocate, at some point, I think people are going to stop even referring to these assets as alternative. I think people are going to have an equity portfolio, and that portfolio is going to have common stocks, ETFs, private companies, private equity funds, maybe some venture funds. The private credit portfolio is going to have munis, treasuries, corporate bonds, and private credit, maybe structured credit, real estate credit, et cetera. And you're going to see a blending of the private markets and the public markets, and people are going to think about how to combine these things to get to the portfolio outcomes they're looking for.
All right, Lawrence, great conversation. Really appreciate your time. Of course, that is Lawrence Calcano. He is the chairman and CEO of iCaptial. And thanks, of course, to Sonali Basak, who has a busy day tomorrow morning. She'll be interviewing Bridgewater Associates founder Ray Dalio tomorrow at the Greenwich Economic Forum. Of course, we'll be dipping in on BTV. Coming up on this program, a rare Amazon skeptic. Up next, we're talking about why one analyst report has shares falling today. This is Bloomberg. This is Bloomberg Markets. I'm Katie Greifeld, and it's time now for the stock of the hour. And Amazon shares, they're falling after a rare analyst downgrade. Wells Fargo Securities cut the stock to equal weight from overweight, with the analyst saying that growth in the cloud computing business is unlikely to compensate for shrinking margin trends. Now, in that same report, the price target was cut from $225 to $183, one of the lowest on Wall Street. For more, I'm pleased to say we're joined now by Bloomberg intelligence analyst Anurag Rana. And the core of this call, of course, coming from Wells Fargo, is that AWS strength alone is not enough. What's your reaction? Because it's interesting to see that shares are actually really getting punished here.
Yeah, so if you look at it, Amazon's done really well over the last 12 months to showcase their profit potential. This is something we highlighted in our report back in November, that there is so much more the company can do. Now, when you look at, for example, operating profit, just let's take just for their cloud division. Last year, operating margins in the second quarter were around 24%. In the second quarter of this year, they went up 35.5, so an improvement of 11 percentage points. Now, obviously, you will not expect that level of improvement to continue over the next few years. Having said that, we feel fairly confident that over the next 3 years or so, you will see higher operating profit from all the divisions coming out. Now, whether things change seasonally in between, whether it's because of investments. So, for example, next year, they're going to do a lot of investments related to Gen AI in their AWS business, which it is possible that's going to curtail their margins. So we don't disagree with some of those things, but frankly speaking, over a longer term period, we think operating profit is going to improve for Amazon as a whole.
Yeah, and talk to us about some of the other divisions. Of course, we spend a lot of time talking about AWS, of course, as it relates to the AI story. But talk to us about the retail, the e-commerce side of the business, because, I mean, Amazon's e-commerce business has been a sore spot for pretty much every retailer in every industry with just its dominance.
Yeah, I mean, if you go back and look at it, during the pandemic, they doubled their footprint of logistics. This is something that is critically needed for them to really differentiate their e-commerce business compared to the others. Now, when you have when you have supply chain challenges, when you have inflation kicking in, you do see, and they're raising the per hour wage for their employees. Those things will ebb and flow. But frankly speaking, they are creating a deeper moat for their business. And again, in the longer term, we think that's going to be far more profitable than what it is today.
All right, Anurag, really great catching up with you. That, of course, is Anurag Rana with Bloomberg Intelligence. And the analyst behind that Amazon call will be on Bloomberg's The Close later this afternoon, so stay tuned. But another company that we're watching this hour, of course, is Pfizer. Shares rising today on news of a large activist investor stake in the company. This is according to a person familiar with the matter. Activist investor Starboard Value has taken a stake of about $1 billion in Pfizer. This, of course, in an effort to spur a turnaround in the company. For more on this, I'm pleased to say we're joined now by Liana Baker with Bloomberg News. And what is Starboard asking for here? Beyond the stake itself, of course, that $1 billion sizable here, but what are they hoping to achieve?
At this point, it's too early to know what Starboard is asking for since no information is public. But as a rule of thumb, activists like to push for different moves that a company could do to help boost the share price. So it's been reported, and we could confirm, that Starboard has approached some former Pfizer executives, including the former CEO Ian Reed. So potentially they would want to maybe bring in some of their own talent, maybe add a board seat. So while it's too early, these are just some things, they could be thinking about.
Yeah, getting the band back together, really interesting moves there. But talk to us about Pfizer itself. Of course, Pfizer, we all know that the success that they had with their COVID vaccine kind of fizzled, of course. What can they do here?
So one thing that we're looking at is how Pfizer could maybe look at the obesity space, because a lot of their competitors have seen success there. And from what I understand, and I'm no healthcare pharma expert, but some of their bets in that space have flopped. So that's an area they can look to expand. And I would say cost cutting, that's already a focus of the current CEO, Albert Bourla, but maybe there's more they could do there. Really anything to help turn this ship around.
Yeah, and you think about Pfizer also trying to rebrand itself as a cancer company. It has things in the pipeline, but it hasn't exactly found that hit like it did with the COVID vaccine. But talk us through what happens next. Of course, we know that Starboard has taken this $1 billion stake. What else should we be looking out for here?
So as I mentioned before, there's not a lot of information about this stake. There hasn't been any public filing yet. So we're looking for any details, if we could see, at what price Starboard bought in at, any moves they could try to make at the board. And also, what is Pfizer's plan to fend off this activist? Sometimes we see companies work with activists, and the activists become so-called constructivists, to use the jargon. So maybe there's something they could do together, but really there is no sort of near-term pressure point. There's no shareholder meeting coming up next week. We don't know if Starboard is going to do a proxy fight or anything like that. So it's still too early to tell what will happen. But we'll be watching whether other activists emerge, because Starboard has gone after companies with other activists before. Salesforce, for example, where we saw an activist swarm. So that's sort of the trend in activist investing. So it would be interesting if another one does emerge.
Well, it'll be fascinating to watch. I know that you and your team are all over it. Our big thanks, of course, to Liana Baker with Bloomberg News. Now, coming up, a new wave of ETFs are being promoted to audiences on TikTok, YouTube, and Reddit, all with promises for payouts that have some insiders waving red flags. That conversation coming up next. This is Bloomberg. Welcome back to Bloomberg Markets. I'm Katie Greifeld. Wall Street is printing new ETFs at a much faster pace than just a few years ago. Now you have amateur investors plunging into the complex world of derivatives-powered ETFs that sometimes promise huge payouts, and pros and regulators are urging caution. This is Bloomberg's Big Take today, and for more, I'm pleased to say that we're joined by one of the reporters behind the story. Her name is Denitsa Tsekova, and of course, over on the cross-asset team, we cover these ETFs all the time in terms of the performance and the flows. But talk to us about the social media aspect of this all.
Yeah, the social media aspect is very important for this boom. If we go to Reddit, we're going to see small issuers like YieldMax having 10,000 people commenting on their lineup of product. If you zoom out on the whole dividend community, there are hundreds of thousands of people gathering every day to discuss what is the best dividend, what is the best fee, what is good for your portfolio. So we decided to look at the numbers more broadly, and they're staggering. We just had to keep updating the data every day because filings kept coming in. It's record numbers of ETFs this year. Derivatives base 160. If you look at the AUM, it's growing so fast. Just 5 years ago, it was 50 billion of that breed. Now it's 300 billion. So it's really, really rapid growth. And there are some small firms, we have the JP Morgan, we have all those big names there, but we have smaller firms that weren't around just 2 years ago.
Right.
Now surpassing 4 or 5 billion in the span of 1-2 years, which is incredible.
Right.
And they're charging higher than average fees.
Well, we only have about a minute left with you, unfortunately, but talk to us about why this is happening now. Why just in the past 2 years are we seeing this sort of explosion of interest?
It's a combination of the rule changes in 2019 and 2020. So definitely regulation allows this more than before. But also 2022 was an interesting year where pretty much nothing worked. And there comes covered call strategies, including the JP Morgan one, that did quite well. So investors got more interested in that approach that's seeking some upside, but providing some dividends on the way. And since then, we've just seen incredible proliferation, so many single stock products. And now people are launching product on pretty much anything you can think with so many twists and turns. So it's a growing space.
Well, it's a great story, of course. Today's Big Take. Bloomberg's Denitsa Tsekova is one of the authors. I would suggest everyone go and read it. But that does it for Bloomberg Markets for now. I'm Katie Greifeld, and this is Bloomberg.